Okay, this is going to be a quick run over of ICT confluences. Um, and pretty much every single little confluence that you'll need to understand my strategy when I eventually explain it down the road. So, first, understanding the market. What are highs made of? Okay, there's highs and lows in the market. These are really important things to understand. Highs are made of a bullish candle and then a bearish candle. Okay, so it's a two candlestick pattern. All right. Now, the highest point of that with the wick is going to be the high. Okay. That's pretty much it. It's bullish candle, then a bearish candle, and the highest point it reaches. Okay. Now, lows are quite the opposite. It's going to be a down candle and then an up candle and the lowest point it reached between those two candles. Okay. And yes, wicks count. It's the same with the highs. So the lowest wick of those two candles is going to be the low. All right. Simple. Now, going into more complicated things, fair value gaps. Okay. A bullish fair value gap. A bullish fair value gap is a three candlestick pattern of all bullish candles with a gap between the first candle here and the third candle here's wick. Okay. So if there's a gap between the first and third candle's wick, that's going to create something called a fair value gap. Okay. What that is an imbalance in the market that price is going to be gravitating towards before moving higher. Okay. So in trading words, it is going to be responsible for a retracement to then move higher. Okay. All right. So now inverse fair value gaps. Inverse fair value gaps are fair value gaps that have had an opposing candle. Okay. So if it's bearish here, then if it's a bearish fair value gap, if you have a bullish candle's body that closes all the way through the fair value gap, this is now known as an inverse fair value gap. The importance of this is it can be used just like a normal fair value gap, but since bulls ran through it, it's now going to be used as a bullish fair value gap. Okay. On top of that, it's also a good indication that market structure is changing and volatility is going towards the other way. Okay. Now, going into yet another gap, there's something called a candle gap. It's when, and generally when market opens or maybe a Monday opens, there's usually going to be a gap between two candles with no candle in between. Okay. And it's just going to be like a void. All right. So the gap is going to be between the two bodies. The wicks don't matter in this point, but it's going to be used just like a fair value gap. It's an imbalance that needs to be filled before going further up or further down. Okay. Yeah, and there's a difference between, they both look the same, but there's a day candle gap and a week candle gap. The only difference is when they occur. So week candle gap is going to be happening from a Saturday to a Sunday, I believe. And then a day candle gap is going to be any day. So, and then boom, break a structure here. Okay. Break a structure is when we are in a prior bullish or bearish trend. Okay. And if you don't know what that consists of, it's going to consist of, for bearish, lower lows, lower highs, lower lows, lower highs. Okay. But in this instance, it went above. Okay. And how do we break structure to the upside? Well, we're going to break structure by breaking above this high here. Okay. So this is a break of structure right here, to be honest. We have a low, a high, a lower low, and then boom. At this point, we have a higher high. At that point, we broke structure because bearish trends need to consist of lower lows and lower highs consistently. If there is even one higher high, it now becomes a break of structure. It's also important to know the body has to be what closes above the high. Otherwise, you could confuse this break of structure for a liquidity sweep and could get stopped out. Like in this example here, if it were to have not closed, or if the body were to have closed below here, this reaction is normally what you'd get, because at that point, it would be noted as a liquidity sweep. I'll tell you about that in a minute. But now we have a break of structure bullishly here. We have a high, a low, a higher high, okay? And then we have a lower low here. Sorry, this is actually a bearish break. I don't know why this example is showing it vice versa, But this is a bearish break because we now have a body closure below this low, which makes it a lower low. Okay, and just like with the downtrend, you need to have a consistent higher high and higher low pattern going on with a bullish trend. If you then have a lower low, you are now in a bearish trend. That's why we call it break of structure, because it's simply changing, right? Next, we are going to go into liquidity and liquidity sweeps, okay? So we know what highs and lows are, right? It's a bullish candle and then a bearish candle, and the highest point that it reached for a high. A low is a bearish candle, then a bullish candle, and the lowest point it reached for a low. Now, something to note with that is liquidity lies above and below every single high, okay? So what that means is if price goes up and reacts after reaching above that high, right? So it doesn't close, but instead leaves a wick and reacts lower with that level, with that high, with that low, then that now becomes a liquidity sweep, which then can lead to other confluences invalidating current structure. So let's say it swept liquidity, then we had a break of structure. Well, those are two confluences that are saying, hey, price is shifting structure. So we're going from bullish to bearish, or we're going from bearish to bullish. Okay, so now that we know what liquidity sweeps are, which is price reaching above a high or below a low, order blocks are important to know. Okay, so order blocks are the move that creates the sweep in liquidity and then the volatile move in the opposite direction. Okay, so for instance, I would actually use both of these candles in this example, but they only use one. But both of these candles here, this move down, created a liquidity sweep, which then created a volatile move up. At this point, it's saying if price comes back down into this, it will likely react the same way. Okay? All right. So those are your examples of order blocks there. Now, equilibrium. Equilibrium is probably the easiest confluence, okay? So we have something called ranges. Ranges are the price between a high and a low. It's also called dealing range, okay? So when you have a high and a low, you can mark it out with something called a fib tool, which I will teach you later. And this will give you the 0%, the 100%, and then the 50% range in between. Now, the 50% range, if not filled, is used like a fair value gap. It's an imbalance that needs to be filled before price goes up. Okay? The market moves for only three things: liquidity, imbalances, and equilibrium. That's it. Okay? Okay, so hopefully that makes sense. Now you go to breaker blocks. Okay? Breaker blocks are created with a break of structure. Okay? So you have prior structure being bearish here, lower low, lower high, lower low, lower high, lower low. And then when we get that break, the higher high, now we have something called a breaker block. The breaker block is going to be the move prior to the liquidity sweep. Or, in the prior example, order block here, it's going to be the move before the order block. Okay? So it's the move up that generates the move down and then generates the break. It's absolutely vital that we break structure with this model. If not, then the breaker block is now invalid and it's not going to hold as strong. Okay? Yeah, there we go. And I'll teach you SMT divergence some other time. That's a little bit more complicated. But now that we know this, I'm going to go a little bit more in depth on the charts for you. And I'm going to show you examples that we can look through. So I'm going to delete everything just so you don't get complicated. There it is. Okay, cool. Okay, so bullish trend. All right, bullish trend. We have a beautiful bullish trend here. Okay, so we have a down candle and an up candle, which generates a low here. Okay. So So there's a low, okay? Then what do we have right here? We have a high. Why? Up candle and down candle. High, right? Then what do we have right here? Higher low. Okay. Then right here, what do we have? A higher high. Okay. And we continuously go in this pattern for quite a while, right? Right. All right. Now, there's an example of bullish trend. Let's look for an example of break of structure here. Okay, here we go. So here we're in bullish structure. Okay, it's actually kind of sideways, which we call consolidation, but it's slowly moving up. Okay, so you kind of see that it's a little bit of a bullish trend here. Okay, now what are we going to wait for? We're going to wait for the first break. Okay, so here we have a low, down candle and up candle, and it's the most recent low. Okay, now we go up, we sweep a high here that also breaks. It's okay, but we sweep a high, and then we have the candle break past this low. Okay, and when we get that break, that is now becoming a break of structure because we now have a lower low. The reason why this isn't a break is because we were already generating higher highs, so we were already in a bullish trend. The reason why this is a break is because we're going from bullish trend now to bearish trend, and we just broke this low. Okay, so there's an example of a break of structure. Okay, now going into fair value gaps here. I don't know if you spotted this or not. This here is a bearish fair value gap. Okay, so we have candle 1 here. Okay, its wick, candle 2, and candle 3 here in its wick. Okay, as you can see, there's a huge volatile gap between the first candle's wick and the third candle's wick. This leaves us with a fair value gap that price wants to run back into to either push further down all the way to external lows or tap into to then disrespect and reverse price. So, as you can see in this example, it did hold up quite a fight until it finally got inversed because we had this candle close all the way past it. And I will find you a cleaner example of an inverse, but just give me 1 minute. Now we go to bullish. Okay, there's a bullish fair value gap, a beautiful one right here. Candle 1 and candle 3's wicks have a gap in between them, right? So you see this candle 1's wick, you see this candle 3's wick, and candle 2 lying between it. This is now a bullish fair value gap that price uses to retrace back into to continue bullish trend. Okay, boom, there you go. So there are two beautiful examples for you on both sides. Now, inverse fair value gaps. Actually, here's a beautiful example of a day gap. Yeah, so here's a candle gap for you. Okay, so boom, that's going to be the candle gap, and that's going to be the candle gap right here. Okay, and all that space in between there needs to be filled because it's now an imbalance. So price comes down, fills it, and then it actually decides to break through. All right. Okay, anyways, inverse fair value gaps. Let's get on to that. Let's see if I can find a nice, easy, and volatile example here. Sure. Let's look at this right here. We have a nice fair value gap right here between the first and the third candle. Okay, we sweep a low on a higher time frame. Okay, so we'll say it's this 4-hour low right here. Okay, and we sweep this 4-hour low here too as well. Price reacts, and then we get a full body closure through this fair value gap. So it now becomes an inverse, and what price can do is go ahead and use that as a rebalancing tool to come down, tap, and then move higher, which is exactly what it did in this example. Okay, so what is this? Well, it's an example, or sorry, a signal that we are changing structure from bearish to bullish. It's a change in volatility. All right, and as you can see, that inverse actually leads us to going through this entire bullish leg. Okay, so there's your examples there of an inversion for from bearish to bullish. Now let's see if we can find a bullish to bearish here. Ooh, there's a good one. Okay, bullish to bearish here. You see there's a beautiful gap between that first candle and third candle's wick, right here and right here. And we see that the candle closes straight through that fair value gap. Okay, now what does that make it? An inverse fair value gap, right? Because we disrespected it completely. So price can come back and reach up. It doesn't have to as a retracement tool, but it's also showing that we're changing structure, just like with the other inverse. All right, cool. Now, a little bit of a trick question for you. This is for like bonus points, but there's also another confluence we have talked about in this example here. If you can't spot it, that's fine. I have trained eyes, and hopefully you will get some soon. But you see this little down candle right here. Okay, this is what we call, and what I was talking about, as a breaker. Why? We're in an uptrend, okay? We have a low, okay? Well, yeah, we have a low here. We have a low here that gets created with a down and then an up candle, and we have a high that's prior to that with an up candle and then a down candle. This here being our high. Whoops. Okay, so boom, we have a low and then a high, and then what do we have? A higher high, which is also a liquidity sweep. Okay, and what does that end up making us do? That ends up making us break structure in one foul swift move. Right, so we broke that low, break of structure. So this makes this little candle here a valid breaker for us to retrace into, just like a fair value gap. Okay? Now remember, a break of structure is absolutely vital to this confluence. You need it. All right? Low, high, higher high, and then a lower low. Boom. All right, so there's an example of a breaker. We could also get a beautiful example of an order block as well. Okay, so we have a swift move that comes down and takes out liquidity. Okay, so this low here takes out that liquidity and then moves higher up. Now, I usually mark out the entirety of these candles, but if you want to accurately do it with ICT, you just do this last candle here, because order block is used as a last line of defense. So what this means is if we break past here, chances are we are now going to break structure downwards. Okay, so if this was bullish, which in order block, in order for it to be valid from this sweep, it needs to be a bullish trend after. But if this is going to be bullish, price cannot come past this order block. So it cannot close below this order block, okay? It can wick, but it cannot have a body closure through this order block. Otherwise, your trend is completely invalidated, therefore your trade is invalidated. Okay, cool. So we have order block, we had a breaker block, we had inverse fair value gap, we had fair value gap, we have highs and lows, we have bullish and bearish trend. Equilibrium. We'll do equilibrium now. Okay, equilibrium is so simple. All right, super fucking simple. We're going to need a high and a low. Okay, so down candle, up candle, the lowest point, up candle, down candle, up candle, down candle. So when we create a volatile move like this, from this high to this low, we now have a dealing range. Okay, so it's just a range that is created between a high and a low in the market. Okay, now price, just like an imbalance, is attracted and magnetized to price coming back down to at least this 50% range, if not further down, okay, to fill this imbalance and then move higher, okay? And majority of the time you'll see it move to either 0.5 or lower, because that is now considered a discount range, and then above is a premium range if you're going in a bearish trend. In a bearish trend, you'll want price to go up to the premium range and then down. When you're in a bullish trend, you'll want it to come down to a discount and then go higher. Okay, and that's a beautiful example right here. You see it come down into the discounted range. You see it fill this fair value gap lying down here. You see it respect it, and then it push higher. Okay, and that's exactly what you want to see. So beautiful. Okay. Something I need you guys to do is practice drawing this out on your charts. Send me the homework. I'll have my Discord linked in the bio. Okay, there's a free section. You can go ahead and message me. You can go ahead and send it in the chat. People in there will help you understand. I'll help you understand. Ask questions. Take advantage of it. Okay, practice this on your chart as if it was homework for a college class. Do an hour of marking out highs and lows. Do an hour of marking out liquidity sweeps. Do an hour of marking out fair value gaps. Do an hour of marking out break of structures, an hour of marking out order blocks, an hour of marking out breakers. And take your time, of course, but please do the work. Okay, the only person you're going to be cheating is yourself. And I'm just trying to help you guys for free. Okay, I'm trying to help you guys understand, because no one deserves to be stuck in a 9-to-5 job. No one deserves to go to college, because at the end of the day, this is the easiest way of making hard money. Okay, and all you have to do is understand the skill, which is 20% of it, and then you just have to master your psychology. And once you get that done, you're going to have something that you can have a sustainable income monthly to rely on. Okay, and I kid you not, it takes 5 minutes every single day to execute a trade. 5 minutes. Okay, and you'll make a gross amount of money compared to your job if you just put in the work and understand what you're looking at. Okay, I'm here to help you. People in the Discord are there to help you. Take advantage of that help. Okay, if not, with all due respect, you're the only person who's going to care. You're the only person who's going to suffer. The rest of us are doing exactly what we needed to do to get to the point where we are. And if you're not going to take those steps, if you're not going to just start, then with all due respect, you deserve to be stuck in that job, that shit situation. You deserve to be stuck in college. You deserve to be that, because you won't do the smallest things to become wealthy, and not just financially, but with time, with freedom. And honestly, you're just weak at that point. And I don't mean to be offensive, but if you don't do it, that's what it means. So anyways, take this advice, practice it, join the Discord in the bio, ask questions, take advantage of the help that you have, and get rich. You have all the resources you need, get rich, and do it with people. All right? Cool. So take this to heart. Ask questions, practice, and then come back to me. Okay? All right.